A very good afternoon to everyone. Welcome to the Masterclass on Unravelling Reserve Bank of India's Monetary Policy. Today we are fortunate to have Professor Amaresh Samantraya, Professor, Department of Economics, Pondicherry University. So pardon me if I'm not pronouncing your name rightly. I guess it's
It's
right.
fine. It's fine. English
Thank
enough.
you. He would be discussing various aspects of macroeconomics, and he would be sharing his valuable perspectives on the same. At present, he's a member of 6th State Finance Commission of Odisha, and he's also a visiting faculty at Indian Institute of Management, Kozhikode, Reserve Bank Staff College, Chennai, Tapmi, Manipal. And he has also worked as an economist in the Reserve Bank of India, Mumbai, during the period of 1999 to 2010 in various capacities in the Department of Economic Analysis, of Policy, Monetary Policy Department, and the Department of Banking Supervision. On deputation from the Reserve Bank of India, he has also served as an economist to the Governor of Andhra Pradesh and officer on special duty to Chairman 12th Finance Commission at New Delhi. Professor Samantaraya has extensive international exposure on the conduct of monetary policy, and he has visited leading central banks, including Bank of England, Swiss National Bank, Monetary Authority of Singapore, and Bank of Korea over the period 2006 to 2008. So I welcome, sir. Now the stage is all yours.
Thank
Thank you,
you.
sir.
Thank you, Dr. Kaur. At the outset, I'm thankful to Chitkara University for inviting me and giving me this opportunity to have some interaction with this group of learners. Uh, any day, I'll be happy to talk about monetary policy. So, my talk today will be a blend of theory and practice. I mean, what is written in textbook and discussed in classrooms with the practical perspective of actual conduct of monetary policy in India, where I was involved for 3 years in the monetary policy department. So let me start directly with sharing my PPT over here. So broadly, the outline for talk today, I'll just very briefly talk about, give an introduction to RBI's monetary policy and maybe a couple of minutes. Then broadly, I'll focus on two things. One, trying to explain how an economy works. I'll be, elaborating again what I mean by working of an economy, so that I may take 20 minutes or so. And then in final part, I'll talk about the intricacies of conduct of monetary policy in India, right? So uh, I think all of us have heard of this thing, monetary policy, RBI's monetary policy in India. Reserve Bank of India is entrusted the responsibility of conducting monetary policy, and this responsibility is derived from RBI Act 1934. Recently, in 2016, it was amended, where the primary objective of monetary policy was explicitly stated to control inflation. And prior to that, RBI was involved in conduct of monetary policy, of course, particularly after 1985 onwards, after the Chakraborty Committee recommendation. But in those days, there was less clarity on the objectives of monetary policy. Particularly 90s onwards, supporting economic growth and inflation control emerged as two dominant objectives of monetary policy. But then there used to be some conflicts, and consequently, with amendment of RBI Act in 2016, now there is a clear hierarchy, and controlling inflation, CPI inflation, keeping it at 4% with plus minus 2% has become the target for RBI. And as many of you, all of you may be aware, every once in 2 months, RBI's Monetary Policy Committee, they meet in their head office in Mumbai, and they deliberate on the prevailing economic conditions in India and abroad. Accordingly, they sort of project the likely economic growth of India and inflation of India for next 6 months to 1 year, and accordingly, they basically frame the monetary policy. And this monetary policy is stated in terms of RBI's decision primarily on repo rate. So as I'm telling, I'll be elaborating everything. I'm just starting with giving an introduction. So in India, there are many types of repo rates. So the repo rate which I'm referring to as RBI's principal instrument rate, it is the repo rate under LAF. So Reserve Bank operates a liquidity adjustment facility. I was referring to the repo rate is the interest rate which RBI charges to the commercial banks for overnight lending. Okay, that is lending for one day only. Okay, so this rate is the RBI's principal monetary policy instrument rate, but there are other instruments also. Like you might heard of bank rate, you might heard of term repo, you might heard of CRR, SLR. There are so many other instruments which RBI uses for its conduct of monetary policy. So, when I'm talking monetary policy, like for any policy, there is an objective, what need to be achieved, and what is the instrument or switch lever which we are using to achieve that, right? So, in that context, two things I'm telling. Objective is keeping CPI inflation at 4% with a 2% plus minus tolerance band, that is keeping CPI inflation, consumer price index based inflation, within 2% to 6%, right? So that is the objective, RBI's monetary policy objective. And to achieve that, RBI's monetary policy committee, which is basically body responsible for taking decisions pertaining to monetary policy, they take a call on repo rate and other monetary policy instruments, so that this target of CPI inflation of 2 to 6% can be maintained. Okay, so this is broadly what is monetary policy is. So these are basically salient features of RBI's monetary policy. Principal target is CPI inflation. Principal instrument is repo rate under LAF. Decision making body is monetary policy committee. This is the committee which includes three experts from academics. Okay, so presently, I'll come back to that. I have a slide where I'll show the names. There are basically three names. The director of Delhi School of Economics, Mr. Singh, and I think ISID Director General, and one more economist. They are the external members. And then within RBI, the governor is the chairman, deputy governor in charge of monetary policy is second member, and monetary policy department head is the third member, right? So this is 6 committee member, which is basically some insiders and some external experts. They together take a decision on reported changes and changes in other monetary policy instruments like CRR, SLR, etc. Okay, and generally decision is taken, unanimously, and wherever there is a difference, there is a voting. Okay, and this monetary policy committee meets once in 2 months. They assess, reassess the economic conditions, and accordingly take a decision on repo rate or other monetary policy instruments, keeping CPI inflation target in mind. So broadly, this is what is monetary policies. And as I said, it's just an introduction. I'm going to discuss details about it as we go on. Okay. Now, the thing is, uh, many times you read something on a newspaper that RBI decided to raise repo rate to achieve this level of inflation. And when you read in a newspaper in a couple of columns, I mean, couple of pages, I mean, not even a couple of pages, a part of a newspaper page, very briefly they cover the things. And when like today we're discussing about monetary policy, 1 hour talk perhaps is not adequate to have complete understanding about monetary policy and how it is relevant for the economy. So here two things are critical. First, we have to understand how an economy works, and then we can understand the context how monetary policy can be used to improve a particular situation. Now, when I'm talking about how an economy works, first of all, what is an economy? Okay, like for an individual, I have a name, I have physical appearance, the language which I speak and different, my educational qualification, job profile. Like there are many parameters we can use, many aspects we can use to describe a person. Similarly, India has different aspect. There is a political aspect, there is a economic aspect, geographical aspect, etc. Right? So when we talk about economic aspect, several macroeconomic indicators we use to talk about an talk about India's economy. So broadly, these are the sets of macroeconomic indicators which are used, and they reflect different aspect of Indian economy. Like we use something called GDP. I think all of you are familiar with GDP. It is gross domestic product that basically measures total amount of goods and services produced in an economy. And if you have undergone macroeconomic course, it is fine. Otherwise, when we'll be undergoing macroeconomic course, you'll be learning that this also represents total amount of income generated in an economy. Like if you add up income of all citizens of our country, okay, which is called typically GNP, or national income to be very specific, that is related to GDP. Okay, and this also represents total amount of expenditure incurred in an economy. So that way GDP is a very important indicator of an economy, which reflects total amount of production, total amount of income generated, and total amount of consumption and other expenditure incurred. So if Indian GDP is bigger, okay, like American GDP, America is the biggest economy in the world, that means its GDP is the highest in the world, right? And if a country's GDP is small, that suggests its size of economy is at aggregate level at a low level, so total income generated in that country is low, and economic growth is nothing but percentage change in GDP. So it suggests at what rate total income in a country, total production in a country is growing, right? So this is the most important indicator. Then we have prices, inflation. Basically, you see why I'm talking about GDP and prices. I think these are the two economic variables I'll combine in this discussion today. So basically, GDP suggests what is total amount of goods and services produced, or what is the total amount of income generated. Now, in economics, we assess welfare of a person by counting how much of goods and services a person is consuming. Like if I'm consuming more of automobiles, more of air condition, big house, you know uh, that suggests my economic standard of living is higher. On the contrary, if I don't have access to nutritious food, education, basic healthcare, then my standard of living is low. Okay, so GDP basically is a gross measure which suggests availability of total goods and services and capability of purchasing those goods and services. Now, without talking about price, perhaps we'll not able to assess about standard of living. If my income is growing at 10%, but if the prices are growing at say 20%, then obviously my purchasing power of real goods and services shrinking over time. So that suggests my welfare is shrinking over time. Okay, so these two indicators are important: GDP and its percentage change, which is economic growth; prices and its percentage change, which is inflation. These two are very critical economic indicators to assess welfare of average citizen as well as all citizens of a country. Okay, so as I said, there are several macroeconomic indicators, but I'll confine to these two. These are most critical macroeconomic indicator to talk about an economy. Now, in this graph, I have per capita income of last 75, 80 years, 75 years or so, starting from 95, 1951, 52, right? I have GDP, which is given in the green line. This is real data for India, and red line, I have per capita income. So what you can see, India's GDP has witnessed an upward movement in last 75 years or so. Second thing, what you observe is initially, that is first 30 years, Indian GDP was growing at a very slow rate. And in last 30 years, particularly during the post-reform period, you see there is a steep, the curve has become steeper, right? So obviously the shape of the per capita income line and GDP are quite similar, although they are not exactly same, because population has been growing at a very slow rate. So I get per capita income, which is basically some sort of GDP divided by population, or national income divided by population. So that's why you see the very similar movement between the two, right? So, but the important point which I want to draw your attention is, as you can see, GDP has been witnessing an upward movement over the years, but then the pace of growth of GDP or per capita income are not uniform. Initially, we are growing at a slow rate. GDP was growing at a slow rate, and in recent years, it is growing at a faster rate. This basically suggests in long run how GDP size of an economy behaves, right? Now, let me come to this graph. So, how I got this line, to the GDP, I mean, to the per capita income graph, which I showed earlier, I have detrended simply. If those of you familiar with statistics, any time series has a trend, long-term trend. Okay. And if they basically, by detrending that line, I'm getting this you know cyclical pattern of India's per capita income, which you see is quite fluctuating, right? If you are not able to get make sense of it, let me take to the next graph, which is basically 3-year moving average of GDP growth of India for last 50-60 years, right? So what you can see here, economic growth is not constant. That all of you know, right? Like this year, we're expecting economic growth in India to be around 6.5%. That is 2024-25. In 2021, we had a negative growth because of COVID pandemic. So economic growth is not constant. Sometimes it is faster, sometimes it is slower. Okay, and these fluctuations are not good for the citizens, right? So when there is a economic slowdown, when there is a economic contraction, naturally the production sale will be low, people will be losing jobs. Okay, if those who are ready to join the job market, for them it will be difficult to find a job. And because all of us are earning our livelihood by working, by basically supplying our labor, naturally when there is a large scale unemployment, it suggests a very bad situation for the country. Similarly, the upswings had some adverse consequences, particularly those years which we refer as overrating years, when basically high economic growth is driven by strong demand. Okay, during these periods, generally, the inflation will be high. So I was talking a little earlier, if you have your income is growing at a rapid rate, but there is high inflation, then ultimately your purchasing power of goods and services is suffering badly. Okay, and moreover, it is observed when inflation is high, some figures I'll show to you, that adversely affects economic growth also, right? So I think I'm showing this in this graph. This is again, I have taken Indian data for the period 1951 to 2023. And what I've done, I have segregated the years in terms of, first in terms of inflation. So then I have grouped them. Like my first column, as you can see in the left, this includes all the years when WPI inflation was less than 3. Then second column, this includes all the years in which, second group, all the years in which inflation was in between 3 to 6%, so on and so forth. Now, for each group of those years, I have calculated what is the average GDP growth. So as you can see, when inflation was high, okay, as you can see that the average growth has been shrinking. So broadly, what I'm trying to tell you, that high inflation is bad. Okay, so two things I wanted to tell you. These two are key macroeconomic indicators, and their pattern, historical pattern, particularly of GDP, what we saw in long run, it has increasing trend. But please keep in mind, the upward movement of GDP was not uniform. Sometimes the curve is flatter, sometimes the curve is steeper. Okay, and these are not by accident, right? There are certain factors which make GDP steeper in some years. Okay, I mean, for a period like last 30 years, there are some factors why it is flatter. Okay, and then second point, what we saw, there have been considerable economic fluctuations, which we say business cycle phenomenon, and Too much of fluctuation need to be avoided. We cannot, completely wish away economic fluctuations, but if the fluctuation, that is amplitude, is low, that is the economic recession or contraction is not severe, it is good. Similarly, if the years are not suffering from very high inflation because of overeating, that is also good. Okay. Now, in macroeconomics, we basically use this aggregate demand, aggregate supply model, which I have shown before you, as a framework to explain these two patterns. What are the two patterns? Why GDP curve, long-term curve, is steeper or flatter, number one, and why they fluctuate. These two aspects in macroeconomics can be explained using this ADS model, which you have in front of you. Again, the macroeconomics is, if I'm not going to details, time is not adequate, but I think the main points I'll flag here so that you understand why I'm showing this graph. You have a LRAS, long run aggregate supply curve, which is basically explains the long term movement of GDP, which I showed that, for 75 years or so, the long term pattern. Now, depending on the movement of SRS and AD, I'll come to that. What are these? There is a economic fluctuation. So, for example, assume, the economy presently at Y star, that is our GDP level is at Y star, that is our long term potential GDP. Potential GDP, I'm basically trying to calculate for a country based on a total number of factories, machines, workers, type of technology which the country is using. So this basically reflects the production capacity of an economy, right? I think it will be easier for you to explain this using the example of car manufacturing. Assume we are talking about Tata Motors, and Tata Motors is the only producer in our country, and our entire GDP consists of Tata Motor cars. So there are two things which determine how many cars Tata Motors will produce. One is the production capacity. Okay, depending on how many factories, how many machines, how much raw material, how many engineers and workers available, and what is the technology it is using, depending on it will have a production capacity. Say the production capacity of Tata Motors is producing, say, 5 million cars in a year. Okay, but then the Tata Motors may actually not produce exactly 5 million. They may produce more or less depending on there is a demand or not. There can be production capacity if they are not able to sell 1 million. Assume they are only selling 80 lakhs, 8 lakhs, right? So then naturally they will produce 8 lakh cars, not 1 million. They may have capacity of producing 1 million cars, right? So this purchase aspect is basically taken into account by the eddy curve. So if the eddy curve, what you see on the graph, assume if it is shifting left, that is showing basically there is a deficient demand. People are not buying enough. So in that context, our GDP actual production will be towards the left of Y star. On the contrary, there could be some years when demand for cars are very high. Okay, so although the capacity, the long-term capacity of Tata Motors is to produce 1 million cars, they may overuse the machines, factories, and basically sort of incentivize what you call overworking, something we use. Uh, Working for extra hours, right? So basically, incentivizing the engineers and workers to work for some uh, couple of hours extra, basically to meet the extra demand. I think you can easily relate, like, during Diwali, during the festival season, generally the production is high. That may not the long term production capacity of a factory, but because in these festival months the demand is high, they tend to produce more by making their workers, machines work overtime. Okay, so depending on demand, your actual production can be to the right of Y star or to the left of Y star. So depending on how far the eddy curve is shifting to the right or left, accordingly there could be economic fluctuations. So if you want to reduce economic fluctuations and ensure the GDP is at Y star, then we need to basically reduce the deviations of eddy curve from what is shown on the graph. Similarly, there could be short-run supply curves also. I mean, supply shocks also. If there is a, say, for example, bad weather, and in India, given that agricultural production is heavily dependent on the rains, so naturally a bad weather will lead to harvest failures, and then short-run aggregate supply will shift to the left, and that will lead to, so basically, GDP falling from Y star, right? So, these supply shocks, short-term supply shocks, or fluctuation in aggregate demand, they may cause our GDP fluctuating from Y star, and that's why you have this type of economic fluctuations which you see on this graph here, the cyclical pattern of per capita income, or the fluctuation in economic growth over the years. So I hope I'm giving you the context. What I'm trying to tell you, an economy basically characterized by several macroeconomic indicators. GDP and inflation are two critical macroeconomic indicators which basically sort of explain economic conditions at a point of time. And it is observed in general in long term, GDP has a upward movement, but whether it is steeper or flatter, that will be basically determined by a factor like total production function, economy-wide production function. If you have more factories, more machines, more workers, better human capital, means skilled workforce, healthy workers, then our total GDP will be growing at a rapid rate in the long run. Okay, so those are the factors which are affecting the LRAs here. Now, monetary policy or fiscal policy, I'm talking monetary policy today. Monetary policy is basically used to influence the eddy curve here. Okay, so when RBI is okay, I think let me use this a couple of data sets to explain how ADS model, which I had shown here, can be used to explain economic conditions. This is a very simple example I'm giving you. These are basically data of economic growth and inflation in India for last 5 years. Okay, this is actually real data I have taken from economic survey and RBI handbook, I think a couple of years data, right? So now if these sets of data which you see for CPI, inflation, and economic growth, I'll put in a graph, I'll have this scatter plot, right? So here you can see to the leftmost, that is 2020-21. This is the COVID year when economic growth was negative at nearly 6%, 5 point something negative, and inflation was also 6.2%, right? This is the data point of pertaining to 2021. And then similarly for other years, this is 1920, 2019-20. This point here, if you can able to see my cursor, where economic growth was around 3.9% and inflation was around 4.8%. So basically for these 5 years, the pair of data, that is GDP growth and inflation, is placed here. Okay, now if you are working in Reserve Bank, you are responsible for conduct of monetary policy, and you are basically taking monetary policy decision in 2021. What you will do? Okay, so we're comparing 2021 with 1920. So definitely 2021 is a bad year, right? Why? Because in 2021 economic growth is negative at 6%, and this is not a right situation, right? You should conduct your monetary policy in such a way that you bring this point to somewhere like in 21 22 you have here, right? To this region as soon as possible, where economic growth will be around 6 to 8%, inflation will be around 4%. So this is the, if you are able to see my cursor, this is the ideal region for you, right? So this aspect, if I want to explain using ADS curve, okay, I'll use this graph now. Okay, so here you can see the vertical line, black line here at around 7.8%. This is like our growth of potential GDP in long run, okay, of the recent years, right? And you have many downward sloping golden color lines and some upward sloping blue color lines, which you can see on your screen. So these downward sloping lines are basically eddy curves, and the upward sloping curves are basically the short run aggregate supply curve. So if you are working Reserve Bank, your analysis will be seeing 2021 movement as compared to 1920. This happened due to leftward shift of the short-run aggregate supply curve. Okay, this blue line shifting from this line to this dotted line, and leftward shift of the aggregate demand curve also, right? This downward sloping line. You can see this line corresponding to 1920 and the dotted line, dashed line, which is corresponding to 2021. So imagine how 2021 there was economic contraction. It happened due to two factors. There is a negative supply shock. Why there is a negative supply shock? There is a lockdown, people could not go to work, right? So we had negative supply shock. That's why there is a leftward shift of the short-run aggregate supply curve. Then there were layoffs, I mean, at least temporary layoffs, and many people lost job. People were concerned about their very life, forget about livelihood. So that's how, the consumption expenditure was affected, investment expenditure by the farms were affected. So total aggregate demand also, curve also shifted to the left. So this way, if you are using ADS model, you can analyze how Indian economy moved from 1920 to 2021 using ADS model. Now, you should do as a monetary policy maker, you should conduct monetary policy in a such a way that this dashed downward sloping eddy line corresponding to 2021 shifting to the right as much as possible. Like RBI's monetary policy and government's fiscal stimulus actually helped the curve shifting from 2021 corresponding line to 21-22 to the right. Okay, so I hope I gave you a broad context of how to analyze working of an economy using ADS model. I'm sure you'll have many questions. Maybe last 5-10 minutes I'll be using to answer your questions. And yeah, so after explaining how an economy works using ADS model, now let me come how monetary policy is conducted. Okay, basically how monetary policy is formulated to start with. So here on the right hand side, I have my ADS model. So assume we are starting with a point where your ideal aggregate demand line is at 82. Okay, but like there is a negative shock in 2021. I just explained earlier. Assume because of some negative shock, your aggregate demand curve at present is at 81. You are able to see my right hand side panel. I'm talking about my right hand side panel and telling, say in the current year, the aggregate demand line is given by 81. So 81 is not a good situation for you. Why? Your corresponding to 81, your output is at Y1, your GDP is at a lower level compared to your capacity, which is Y2, right? So the central bank can do better by conducting monetary policy in such a way that AD curve can be shifted to the right, that is 81 shifting to the 82, so that you can produce at your long run capacity level, which is given by Y2. So this we call expansionary monetary policy, where interest rates are lower. I'll come to that. Expansionary monetary policy is basically RBI's or central bank's decision to push aggregate demand in the country to a higher level, aggregate spending in a country to the higher level, so that economy is producing at its potential level. Now, contrary to that, there could be situation where, at present, maybe your aggregate demand is given by 81, which is higher compared to what is required in the long run, right? So when your aggregate demand curve is at 81, you see prices at higher are higher at P1. It is like inflation is high. So you need to control inflation. The central bank can do that by adopting contractionary monetary policy, where 81 will be pushed down to 82 and the economy will be producing at its potential level, and inflation will be at the target level at P2. Okay, corresponding to P2, right? So this is basically broad summary of how monetary policy is used for economic management. So I'm repeating, summarizing. So basically the monetary policy, through the central bank's decision on various interest rates or statutory reserve rates, through its OMO operations, influences the aggregate spending decisions in an economy. And this the shifting of aggregate demand curve through monetary policy action ensures that economy is producing at its long-term capacity. Okay, and this is basically reducing the fluctuation of GDP from its potential level or long-term capacity level. Okay, so this is basically to give you a broad context of how monetary policy is relevant for an economy. Now, what I'll do, I'll maybe spending a couple of minutes. You have, if you have any doubt on what I said, maybe I'll take a couple of questions if you want to. I'm sure my discussion was very brief to explain an economy, so possibly you will have some doubts. So if anyone has a question, you may please raise your hand. I'll take a couple of questions before I move on, if it is permitted. Dr. Kaur, is it permitted? Shall I take some questions if they have?
Yes, sir. Sure, sir. If any
Yeah.
questions, you can take.
Yeah, I'm saying, Mr. Krishnik Singh, please go ahead with your question.
I'm audible, sir.
Yeah, yeah, you're audible.
Hello, sir. Very good evening, and such a sincere gratitude I would like to put forward to you for providing such a precious time out of your busy schedule. So, I would like to ask a question, like, as you know, sir, like, with respect to 2024 and 2025, RBI and it's a widening savings investment gap in today's time. And the decline is in the household financial savings rate possesses a significant challenge in today's time. And as per the Reserve Bank of India's latest financial stability report, it indicates that the financial savings of the households is dropping to 5.3% of GDP in financial year 2023 with respect to 7.3% financial year 2022. So how you figure out or how you look forward to it? Like it's considerably below the 8% average seen over the previous decade, and
Okay.
how it's actually rising in non-performing assets. It's my second question. So it how it hampers, right, sir?
Okay. Okay. The two things, two questions are very interesting. The first one, the savings. Okay. The savings are basically the base for investment, right? So, as you rightly said, the high savings are critical for sort of supporting and engineering high level of economic growth. Now I'll just give you some data for others, how it is relevant. I think Mr. Singh knows about it, so he had a question. In 1950s and 60s, India's saving rate was around 10%. By saving rate, I mean the total savings of an economy to the GDP ratio. And in those days, we are growing around 3.5%, as if you remember, right? In 80s, after bank nationalization and several, initiatives in the financial sector, the saving rate of India jumped to nearly 20% in 1980s. And 1980s, Indian economic growth also accelerated to nearly 5.5%. And then finally, in the post-reform period, Indian saving rate has been largely high, around 30 to 36% in different years. And then we are witnessing this average growth rate of around 6.5% for last 30 years. So sustaining high saving rate is critical for long term. The graph which you saw, that long term pattern of Indian GDP, okay, for that matter, any country's GDP is critically depend on this savings, which are domestic savings, which are basically the base for investment, right? So in that context is critical. So if savings are falling, is a matter of concern. But some fluctuation is fine, 35 to 34, or 35 to 36, some fluctuation is fine. If there is a drastic drop in saving rate, it should be a matter of concern. That will slow down our growth. But fortunately, our savings are largely robust. Some fluctuation are there, but largely robust. And financial savings are critical because, basically, if you are saving in the form of gold, jewelry, or a piece of land, some physical assets, right, which is not converted into productive investment, then it is bad. See what I'm telling, financial saving, how it is converted in productive investment. If you are saving in the form of fixed deposit, if you are saving in the form of buying bonds and equity, then this bond is borrowed by a firm who is basically installing a factory, or a household purchasing an apartment. These are basically productive investment, which is good for the system. So if there is a drop in financial saving rate, that's a matter of concern. Now here, how monetary policy can contribute. If monetary policy will help keeping inflation low, then that is conducive for high savings. Because as a saver, what you look for? You look for return, and your real return drops with high inflation for a given nominal interest rate. Okay, so by controlling inflation around 4%, 6%, RBI can contribute in incentivizing financial savings, which will be basically critical for our long-term economic growth. And about NPA, you were telling, that was bit different, but if there are now, of course, inflation in loan delinquencies are improving, in the sense NPS have fallen, I think, 17, 18 onwards, and it is under control. But then if NPAs are high, then it is bad for monetary policy, because if financial instability is makes monetary policy important. Basically, if there are high NPAs, that means banks are not getting their resources back which they have lent out. Okay, then that is basically restricting their ability to lend further. Okay, so that's a bad thing, and that will basically not able to generate bank credit as much required by monetary policy at a particular point of time. And as you know, with NPAs, again, there is a high provisioning, so that further drains out a bank's resources. So high NPAs is bad, but things have improved now. I think I have another 15 minutes, so let me go ahead with another maybe 5-10 minutes of discussing remaining things what I'm trying to do. Then I'll take up your questions. I'm seeing Mr. Sunil Ahuja raising his hand, but please allow me to take your question after I complete another 3-4 slides where I'll basically wind up my discussion from my side. Is that fine?
Yes, sir. Yes, sir.
Yeah. Okay. So now let me give some flavor of how RBI conducts monetary policy. So recently, I mean, this latest monetary policy decision was taken on February 7th. So monetary policy committee had met during February 5 to 7 of this year. And then the decision was to reduce the repo rate under LAF by 25 basis point from 6.5 to 6.25. Okay, and the repo rate was at 6.5% for last 2 years or so. I think February 2023 it was raised to 6.5. So for last 2 years it was at that level, and in the latest monetary policy committee meeting they reduced to 6.25. That is what RBI's decision was. And on what basis it had taken decision? It had taken decision based on its inflation projection and output projection, which is given in these graphs. But I don't know how many of you are trained to interpret, but otherwise I'm giving the information, major information from that, what is reflected in the graph in this PPT. So basically for 2025-26, according to RBI's projection, GDP growth is likely to be 6.7%, and inflation is likely to be 2.2%. So keeping in mind these two figures, if you remember, I had shown you the graph, a scatter plot with economic growth and inflation. So before monetary policy decision, RBI projects what is the likely growth and likely inflation of the for the year ahead, and accordingly it takes monetary policy decisions so that to keep inflation within the range of nearly 4%, which will ensure that GDP growth is at its potential level of 7% or so, 7 to 8% or so, right? So this is the background. Now, to basically attain that 4% level of inflation, okay, what RBI does? RBI undertakes liquidity management operations. I'll explain quickly what is liquidity management operation. Say for example, changing repo rate is a liquidity management operation. If RBI is raising repo rate, what does it mean? Borrowing by the commercial bank from RBI becomes expensive. So that will basically act as a disincentive for the commercial banks to avail loan from RBI. So accordingly, that will slow down their lending. Similarly, when RBI is conducting open market sale of government securities, so basically it will open market buying of government securities, Okay, anyway, I can explain. If it is selling government securities, that means commercial banks who are buying government securities from RBI are paying to RBI back for those securities, those bonds. So then resources are basically mopped up, from the system, and RBI is basically withdrawing that amount of funds from the commercial bank. That will be slowing their sort of lending ability. Okay, so these liquidity operations, by sort of reducing the resources available to the banks or injecting additional resources to the bank, it affects the overnight interest rate, which is the call money rate. So call money rate, if you are all of you are familiar, this is basically the average interest rate at which commercial banks lend and borrow from each other. On any day, a commercial bank which is in need of fund approaches other commercial banks also, not only RBI, other commercial banks also. Similarly, commercial banks which are having surplus fund, they lend to other commercial banks who are in need of fund, and the rate at which they lend borrow from each other, that average rate is the call money rate. So call money rate is basically the first indicator which suggests whether there is adequate liquidity in the system, banking system, or not. Imagine when more banks are having surplus liquidity, surplus funds, then naturally there will be many bankers who are ready to lend compared to the demand for funds by the deficient banks. So in that call money rate will be low. On the other hand, if most of the banks are having tight liquid situation, then call money rate will be high. So this is the first indicator which can be used to assess the liquidity positions of the bank. So RBI, through its liquidity operations, try to influence day-to-day movement of the call money rate. Now, the call money rate movement gradually gets reflected in the interest rates of all sector market which we have, whether it is a banking sector, bonds market, money market, etc., etc. Okay, I'll have some data to show you how it happens. And now, when interest rates are low or high, depending on that, people have incentive to borrow or disincentive to borrow. Accordingly, it will affect our decisions to set up a project, buy an apartment, buy a car. Okay, those are funded by the bank lending, and by affecting the expenditure decisions of the households and the producers and the firms, that aggregate demand which I showed earlier gets influenced, and the movement of aggregate demand leads to movement of prices and movement of GDP, compared to the potential GDP level. And that's how, that finally affects the inflation, as I showed in that ADS graph. This is basically to tell you how RBI sets the path for the call money rate, right? So the call money rate is given in the blue line, and you have repo rate given in the red line. Reverse repo rate, another policy rate which RBI uses, linked to repo rate. Okay, so as you can see, when RBI was reducing repo rate from April 2001 up to maybe April 2005, you see call money rate is gradually falling. And when repo rate, reverse repo rate was raised afterwards, 2004 onwards, you see the call money rate is rising. So you can see, RBI is able to manipulate the movement of call money rate through its liquidity operations. It was earlier, initially early part of 2000s, and this is for the latest period in April 2022 up to October 2023. You can see that the blue line, which is the call money rate, its trajectory is in a way driven by the policy instruments of RBI in the form of repo rate and other interest rates linked to that. Now, as I said, the repo rate need to be, see, ultimately you and me, like as a household or as a firm, we are not borrowing at the repo rate. The interest rate which affects my decision to buy a house is basically the rate at which I'll avail the home loan, the rate at which I can avail a car loan, right? Or if I have a producer, the rate at which you will basically get a project loan or your working capital loan. So ultimately, for you and me, call money rate doesn't matter, but it's the banking rates or bond market, money market interest rates which matter. So I have shown here how the call money rate movement given in the yellow line is gradually getting transmitted to other interest rates. I have here 91-day treasury bill, 5-year GSEC, 10-year GSEC. You see that there is a similar movement in other interest rates following call money rate. And this is for the banking interest rates of recent years. You can see that largely you can see that movement in the call money rate is getting reflected in the lending rates and deposit rates of the banks. So this suggests RBI through its liquidity management operations is able to influence call money rate, and policy driven changes in the call money rate getting reflected in other interest rates. To what extent it actually influence GDP and inflation, to assess that I have undertaken some econometric analysis, and quickly I'm discussing the result here. So basically here we have something called vector auto regression analysis. Those of you are familiar with econometrics, you may be knowing. So using data on various economic macroeconomic variables, I have estimated a vector auto regression model for India, and from that model, it is based on real data, right? We can assess to what extent monetary policy is able to influence inflation and economic growth. On the right panel, I'm showing that when RBI had undertaken monetary policy accommodation, that is reduced interest rate, how it has affected inflation in India, right? So the blue line basically reflects that what it suggests: when RBI adopted monetary policy expansion, inflation was higher. As you say, if say assume period one, RBI has adopted monetary policy accommodation. In the following period, you see inflation spiking, okay, and then gradually that impact is tapering off. Similar impact also was observed for the impact of monetary policy on economic growth, which I've given as GDP on the in the left hand side panel. Here also you see monetary policy impacting economic growth in India over the years, but as you can see, the impact on inflation appears to be stronger and statistical significant compared to that in the previous diagram. I'm sure I know you will have questions on this, because those of you are not familiar with econometric analysis. Now, last 5 minutes I have, and I'll be spending the remaining time to answer questions. In fact, I'm available even beyond that. So depending on how much time available for us, I'll be happy to answering your questions. So, Mr. Rahuja, shall we go ahead with your question?
Yeah, good afternoon, sir.
Good afternoon.
Sir, you have explained in a very, very crisp manner all the terms which are relevant for the economic growth as well as inflation, and the graph which you have shown us, sir. It clears our doubts. So now my question is that as a macroeconomics, sir, this Trump 2.0, because last MPC RBI has adopted the neutral stance. So after this event of Trump, when the tariff war is going on, sir, whether there will be some impact, because our imports will be costlier now, and we are having trade deficit. So what will be the impact of the economy? Second question is that India has a target of becoming a developed economy. For that, what are the factors required as on date which the government should consider to become a developed economy, considering the macroeconomic factors which are prevalent as on date, sir?
Yeah. So as both of your questions are very interesting and quite valid. So the first one, whether this trade related protectionism which under Trump America is likely to follow, does it have any consequence for us? In our February 25 meeting, our MPC has already taken into account. This slide which you can see in front of you, I didn't discuss, I didn't elaborate, but then as you can see, when they were projecting GDP growth of 6.7%, they have taken into account the favorable factors as well as the challenges. So if you see in the challenges, the second point is talking about it. They have factored in the protectionist trade policies of US, which are likely to negatively impact our GDP growth, right? So this is already factored in. Okay. So despite that, the projection of GDP growth at 6.7% was made. Okay. Now coming to your second question, whether how to go about our long-term objective of being a developed country or rich country by 2047 or 2050. What is critical is the factors which affect our long-term growth. How to make that long-term growth line which I showed you earlier, how to make it steeper and upward sloping without any disruption, right? So for that, what are the factors required? The proximate factors for for raising GDP in the long term is basically number of factories and machines, number of engineers and workers, improving our technology of production, right? So as long as we are able to sustain that, then it is not impossible to become a rich country maybe in 2050, or a couple of years here and there, doesn't matter, right? So during post reform period we have done better compared to first 30 years after our independence. Now if you can sustain it or improve it further, then I'm optimistic of hitting or sort of achieving the dream of Bikasit Bharat. Okay, and that is my short answer to your question. Yeah,
Thank you, sir.
thank you. Yeah. Mr. Singh, you have raised your hand now, but I think you had also a question earlier. So if we'll give opportunity to someone else. If there's no question, I'll come back to you.
Okay, sir.
Yeah,
Completely fine. Thank
yeah.
you.
Mr. George or Donnell, I'm not able to know he or
Yeah,
she.
yeah, yeah. Hi,
Yeah,
sir.
yeah, yeah.
Yeah, so I just have a question. So, sir, you showed a graph first, the per capita versus the GDP. So, in
Mhm.
that, like the earlier years, always the GDP was like under the per capita, but it crossed right the lines. So, what caused that per capita income decrease?
No, they're in different scale. The per capita income will be, say, presently around 1 lakh, right? So it is different scale. If I have two different graphs, okay, then you will not have this intersection. So there
Oh,
is intersection because they are in different scale. Okay, let me show to you in case you're not clear about this point. Let me come back to. Yeah. So you see, the per capita income is on the right hand side scale, right? This 20,000, 40,000 rupees. Okay. And GDP, this is in rupees crore. So they're in different scales. So they're, intersecting. Otherwise, they will not, right? One
okay,
is couple of thousands, another is in crores.
okay, sir. Okay.
Yeah. Yeah.
Yeah, one more question. So
Yeah.
you showed one more graph. I think the 11th slide.
Mhm.
So the economic growth. So it is kind of
Yeah.
always reach a level and it will come back. It's a cycle, right? Always. So what do you think about the next maybe the decade? So whether it will come back like in that specific level from that specific level, whether it come back down or it will go to a next level.
Excellent. What you see here, there are two things you are seeing. One, the economic fluctuation, that amplitude, the highest point and the lowest point, that fluctuation was more severe during 60s, 70s as compared to the recent years. See, in the recent years, you don't see much downward swing. You have one around 2001, if I'm confining to post-reform period, okay, and one in 2020, that is the COVID year,
Okay.
where there is a severe drop, right? Otherwise, our growth rate was above 5% all the years after the post-reform period. Okay, so this suggests there is moderation in economic fluctuation in the recent years compared to the past. This is not only true for India, this is true for many advanced economies and emerging economies. It is because now there is a better understanding, our understanding about how one economy works. This economic, that ADS model which I showed to you, these ideas are developed over the years, starting from the classical ideas, Keynesian ideas, and today's idea. We have basically launched, mm, there is initial understanding, then the developments like the Great Depression, stagflation refined our thinkings, we improved our way of analyzing the economy. So with that, we also improved our capability of using fiscal policy, monetary policy to reduce the economic fluctuations, right? So, I mean, going forward, my projection will be we'll do better. We'll do even better.
Thanks, sir.
Yeah, yeah. So,
So
if there's
can
no
I
other,
ask one question? Can I ask?
please.
So actually, if we look at this chart of economic growth, so there
Mhm,
was fall one in 2000, as you were discussing. Then again, it was in 2020. These
mhm.
were the major shocks in the world economy. 2000, we can think of U.S. invasion in Afghanistan, maybe those factors. So nowadays, again, we are going through the geopolitical tensions. So is it going to impact the Indian economy the way it has impacted in the past, in 2000 or in 2020? So can we assume that there would be some impact
Well,
on the.
yeah, yeah. During the post-reform period, we are now, integrated to the rest of the world. So we cannot be insulated from the global developments, that's for sure. But then, unlike China or some other emerging economies, we are relatively less open. Okay, so as I said, we cannot be completely insulated, but as long as our GDP, our aggregate demand is largely domestic driven, our household consumption expenditure is nearly 55 to 60% of overall GDP. Our domestic investment, our investment as a share of GDP is nearly 30%. So that way, we are not suffering like some other economies who are heavily dependent, highly integrated with the rest of the world. But yes, we cannot be completely insulated. So when the American economy has a slowdown or our other export destination had problems, then definitely we'll have our exports will be getting adversely affected and our economy will suffer.
Thank you, sir. I think there's a question by Navneet.
Yeah, please go ahead.
Good evening, sir. Good evening, everyone. So this was a wonderful, insightful session, and it has definitely broadened our horizon. My question is, how does RBI monetary policy impact startups and investors? Especially in a high interest rate environment.
Yeah. See, basically, the RBI's monetary policy is a macroeconomic policy. Okay. So it is not sector specific, distinguishing between a startup or an incumbent, large farm, small farm. For that, we have fiscal policy, some incentive given by the government as in the form of tax concession or some interest subvention. These are, I'll tell you, there is a gentleman called Timbergen, an eminent economist, who has suggested this, what you call it, rule, I'm forgetting the term. Basically what it suggests, for each objective you have an instrument. Say, yeah, if I'm fever, I'm taking paracetamol. If I have some other disease, I'll be taking some other medicine. So the main objective of monetary policy is ensuring low inflation. Like today, the main objective is keeping inflation at 4%. Okay, so that is the objective of monetary policy. So the interest rate decision which RBI takes is to affect aggregate expenditure, our spending decisions, which are financed by borrowing. Okay, and for a given capacity, by influencing the total spending, it is influencing the inflation. Okay, I hope you got the answer.
Right, sir. Thank you, sir.
Yeah. So, Madam Kaur, as I said, I am free. I don't mind taking some more time if there are some more questions, but it is up to you. Depending on your schedule, you can decide when to close.
So we can take one question from Santosh, but Santosh, can you please make it fast, and sir, we can take another 2 to 3 minutes.
Sure.
Yeah, hello, only one question.
Yeah.
Like we wanted to reduce the import from the China, and we want to manufacture most of things in India itself, but we ended buying like 100 billion from China. And now America is saying they don't want to import anything from the other country. So what will be the consequences? Will they will succeed, or it will continue like the same thing only?
Okay, this is more of a trade policy. So trade the type of trade policy we had followed in last 20 years, 30 years, that has an impact, and these things cannot be changed overnight. So our dependence on Chinese import was a consequence of type of trade policy which we had sort of formulated some 20 years, 30 years before. Okay, so maybe had we had some foresight that this way we are going to be heavily dependent on China, or we are not taking advantage of the changing global trade, WTO rules, and equipping ourselves to benefit like the way China benefited. So let us accept it. Last 10, 20 years, China has become world's factory, and we have become world's office, right? So in a day, we cannot change the situation. But I think, in my personal view, the type of policy like Make India and support to startups and other policies, Atmanirbhar Bharat, etc., which have been undertaken, that will have impact, provided they are pursued properly. But that has to be also coordinated with the type of domestic industrial policy which we are formulating. As I said, time is short, but I'll advise you, there is a very interesting book by Aravind Panagaria, the 16th Finance Commission chairman. The title of the book is India Unlimited. Please read that. I think chapter 3, 4, where he's highlighting the weakness of Indian manufacturing and industry, why it is very challenging to be competitive in the world and compete with China. There are some practical aspects which perhaps we need to take into account. And time is limited. Had I been had more time, I could have elaborated on this. Thank you.
Thank you. So now it's time to wrap up. Good evening to everyone. It's an honor to deliver the vote of thanks for this enlightening masterclass on unraveling the monetary policy. So, firstly, I would extend our deepest gratitude to our esteemed speaker, Professor Samantraya, for his valuable insights and broadening the horizon of learning for the learners. The thorough analysis and expert perspectives they have provided us with a deeper understanding of the complexities as well as the dynamics of monetary policy. And a special thanks to our Dean Academics and the whole team of Chitkara University Online in planning and executing this masterclass flawlessly. The university's efforts they have led to create a platform for meaningful learning and discussion. And last but not the least, to all the learners of online MBA, thank you for your engagement and these thoughtful questions that you have made this session a wonderful place. So your participation, it has greatly enriched the experience for everyone. And thank you, everyone. Thank you so much for attending this session and have a great evening. Thank you.
Thank you. Thank you.